Good afternoon and welcome to the CG Asset Management Capital Gearing Trust half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Head of Investor Relations, Katie Forbes. Good afternoon.
Hello and good afternoon, everyone. Thank you very much for joining us today for Capital Gearing Trust interim results announcement. Before I hand over to the team here, I just want to quickly go over the disclaimer. So please note that the value of investments can go up and down, and nothing we say here should be taken as investment advice. Now moving quickly on to the highlights of the interim results. Please note that the NAV total return has beaten inflation over the past 6 months. We are at 3.4%, and share price total return has been 4.3%. We have a very active discount control policy, and our shares have maintained trading close to NAV. During the presentation, Emma and Alistair will go into more detail regarding our asset allocation and what has contributed to performance. But as a quick summary, a majority of the returns came from the risk assets portfolio. Also, it's important to note that during this period, Carl Sternberg has been appointed as CGT's new chair, and he has maintained that the purpose of Capital Gearing Trust is to maintain and preserve your shareholders' capital. Now I'll hand over to Alistair Lang, CEO, and Emma Moriarty, Portfolio Manager, to get started with the presentation.
Good afternoon, everyone, and welcome to this webinar. So I'm going to cover a bit of the activity over the half year, and then Emma will look at outlook going forward. So as Katie explained, over the half year, our NAV total return was 3.4%. Hopefully, the share price was a little better than that. The discount narrowed slightly over the period. All aspects of the portfolio, with the exception of our index-linked bonds, performed reasonably well. We will cover that off in more detail. But suffice to say, the standout performers were our equity holdings, delivering a little over 13%. And the biggest detractor in the period were our index-linked bonds, where the bond yields rose slightly over the period. So as at the half year, our portfolio was, we had about a third of the portfolio in our managed liquidity reserves, which is the highest quality, lowest risk assets in the portfolio. That is a very high weighting. We have about 39% of the portfolio in index-linked bonds. The makeup of those bonds have changed a little bit, and we will run through those. And we have only a little over a quarter in risk assets, effectively equities. All of those equities held, or majority of those equities held in different investment trusts. At 27%, that is a very low weighting for us. And over the period, we have been realizing risk assets and putting them into low risk opportunities across the bond and managed liquidity reserves portfolios. So as Katie has mentioned, I mean, this has been a strange half year really, because it started in March, which was not quite at the trough of the tariff bear market, but it was somewhere fairly close to. So this has actually been a very bullish kind of risk-on half year, albeit if you look over the calendar year, as we'll cover, the US equities in particular have not been delivering in quite the way they have over the last few years. But as it happens over this half year, it was a very strong risk-on period. As I mentioned, our equities, which are about 15% of the portfolio, delivering a contribution of 1.8%. The alternatives, which are largely infrastructure investment trusts, also delivered very strong returns, and credit, another kind of credit, also delivering reasonable returns. So if we look at the changes in the portfolio from the 31st of March, you can see that the cash and treasury bills remain fairly similar. Credit has expanded a little bit, but the main category that has grown has been our holding in UK index-linked bonds. It has been a weak period for bonds, and it has been a notably weak period for UK bonds. Particularly over the summer, things have stabilised a bit, but there was a period of real rising bond yields. We took that opportunity to invest into index-linked on the improved yields that they're offering. Whilst there are risks in the UK bond market, which Emma will touch on, it is a great position from the point of view of a low-risk manager to have index-linked bonds guaranteeing returns over the life of the bonds in excess of inflation. And it is probably worth pointing out, as we think about the performance over the half year, it is disappointing that the index-linked bonds didn't deliver positive returns. But looking over the portfolio balance, it's quite nice to have a period where, when risk assets are performing strongly, defensive assets like index-linked less so. In a sense, that was the opposite way around from the 6 months previously. And really, we are seeing a return to an environment where bonds and equities are performing in a slightly different way, and it gives the portfolio very high levels of stability. You can see that the three boxes at the bottom of this chart, being the risk assets collectively, equities, properties, and alternatives, have reduced from about 30% down to about 27%. The main reduction you can see there relates to the alternative category, and I will touch on that in a little more detail. So stepping back a little bit, this looks at the performance of the risk assets, the equities on one hand, and then our bonds on the other. Within the bond category, we take out cash and treasury bills to try and get a sense of like-for-like performance, looking at suitable indices. So over the last 10 years, our equities, our risk assets have materially outperformed the investment trust index. That's what we would expect to see, and UK equities, investment trusts being a subcomponent of UK equities. So that run of performance, relative performance continues. Our bonds, again, over the long run, have significantly outperformed. We're comparing them here to sterling aggregate. In both areas, we've seen reasonable outperformance over the long term, which is, and we've continued that trend. So it was really 6 months ago this period started. It feels like a long time ago, but in the bear market around the announcement of tariffs, it's kind of hard to remember, but the MSCI World here fell essentially 20% peak to trough, from the kind of February peak down to the April trough, and subsequently has rebounded very strongly. But it was a very good stress test of the portfolio. And as I explained earlier, in 2022, there was a issue really of equities and bonds selling off collectively, and all assets falling at the same time, which made it very hard to have a defensive performance for a long-only manager. What we've really seen over the last few years is some of the negative correlations between these different asset classes re-established. And as a result, you can see that the NAV, capital giving trust NAV, over a period that the equity market fell, getting on for 20%. I think we were off a couple of percent. And that's the kind of robust downside performance we would expect. And it gives us some comfort that looking forward into what we believe could be a very difficult period for risk assets, this portfolio should have resilient qualities and should play a robust role in investors' portfolios. So I thought I'd lift the lid and really talk about a few of the opportunities that we've been looking at in more detail. As I mentioned, it has been a very strong period for our conventional equities. There are any number of trusts that we can talk about, but I will talk to a number. But it's great to see markets outside the US having a really strong run. Japan would be a great example. I think even including the pull down of the last few days, Japan is up year to date, calendar year to date, about 17%. That is the Japanese index, compared to about a 7% for the S&P 500. So you've seen a number of markets, including emerging markets, Europe, Japan, actually pulling ahead of the US this year, which is much more suited to our asset allocation. We've also seen some examples of discount narrowing, so the kind of classic kind of approaches and techniques that CG look at have been working much better. So this is one example. We have a big holding to Japan overall. If we rewound a few years, it was largely in an ETF, but over the last couple of years, particularly 2023 and 2024, there have been some much better opportunities to get into investment trusts. Here we can show Fidelity Japan, a position we built up significantly in September 23 and September 24. You can see their discounts in the double digits. Fidelity Japan actually had been, as a trust, had been underperforming for quite long periods of time, which may raise the question of why it was attractive to us. The board had been making increasingly strong discount control statements and also put in place a tender mechanism that would pay out close to NAV if the trust continued to underperform. So this was something that attracted us in. We knew that either this trust would significantly outperform its underlying markets, or we would get back a significant portion of our investment at NAV, which is the kind of win-win transaction that we particularly like. Actually, as it transpired after an ongoing period of weak performance and then a manager change, the trust undertook a full review earlier this year, and they have decided to roll over the vehicle into another investment trust called AVI Japan, AJOT. This is a very highly rated Japanese trust. Under the exit terms, we were able to get half our money out at NAV, and because AJOT trades much tighter, it does itself have a much better discount control mechanism. We have enjoyed a period of strong performance, both from the underlying performance of the portfolio and that discount coming right in over the last 6 months. So we have a number of Japanese holdings that have benefited really from strong underlying performance and discount narrowing. Emerging markets have been another very fruitful area, and I thought I'd take the opportunity to cover off a few of our larger positions and also talk a little bit about a question we're often asked, which is why we have such a broad spread of positions in the portfolio. Well, one way of framing the answer to that is that there are approximately 90 companies in the investment trust universe that have discount control language around them, and about 50 of those trusts that have hard discount control mechanisms, tenders, or take very kind of significant actions to control their discounts. This throws up lots of opportunities to be rotating in and out of positions, and it can sometimes be hard to build up really large positions, but collectively these can be material. So we had 3 main emerging market positions, which were between 50 basis points and 70 basis points between them. So overall, we have just under 2% of the portfolio in emerging market positions, which compared to a 15% of the portfolio in conventional equities overall represented quite a significant allocation. So in some ways, the most attractive one was Mobius, that is MMIT. Mobius, we built up a big position because there was a certain return of investors' capital at NAV, 100% tender. So we knew we'd get the performance of the underlying portfolio plus NAV narrowing. As it happens, the underlying portfolio of Mobius didn't have a brilliant kind of 6 months. So even though we absolutely secured the discount narrowing with 100% certainty, it actually wasn't the strongest performer. And this can always happen. And essentially, this is why you often want a spread of investments. So another big position, currently our biggest position in emerging markets, was Aberdeen Asian Smallers. This was a position that we entered via a convertible bond, which matured in May. So we had been buying, really over a number of years, but very heavily towards the end of last year and over the early bits of this calendar year, such that we ended up owning almost half of the convertible bond. And it was exactly a kind of trade that we love. We had the downside of a bond, and as it happened, in May when the bond came to convert, we ended up with the equity upside, and that trust has subsequently gone on a spectacular run. So we have been very, very fortunate there, but it just shows there was another kind of technical way through the investment trust market that you could deliver returns, risk-return profile superior to the underlying portfolio. And then the final one to mention, Fidelity Emerging Markets, actually the strongest performer. We really built that position after the NAV blew out about 12 months ago in September, October 2024. It blew out into kind of low teen discounts. The board was really stepping up its language around and also introduced performance-based tender. We were extremely fortunate with the performance, which has been absolutely phenomenal over the last 12 months. So collectively, these trusts, for a range of different reasons, they all had attractive features, and they have all performed well for us, and collectively they represent a reasonable part of our total equity holdings. The other large part of our risk asset portfolio is invested into alternatives, mostly into infrastructure. If we rewind to March, we had core infrastructure was the largest section of our alternative holdings, but we did also have probably getting on for 40% of our holdings were in renewable energy infrastructure stocks. Indeed, in March, the price had been quite weak, and we were at that point modestly adding. We were extremely fortunate that over the summer, not only had these companies performed very well, but that was also against the backdrop of the bond market selling off quite hard. That's the point at which we were adding to our UK index linked position. So there seemed to be really quite a marked disconnect. And fortunately, we took that opportunity to exit in entirety our holding in UK Wind and the Renewable Energy Group, and also Foresight Solar. We exited most of our position in Bluefield, such that we do still have a position there, but much smaller, and our last substantial holding within the renewable infrastructure area is GCP infrastructure. It's not exclusively renewables, but it has a significant element of renewables in there. So that was fortunate timing, because since that point, renewables have been very weak, and we managed to participate in significantly more on the upside than the downside. Sorry, I seem to have lost control of the slides here. Okay. Moving onwards, I just thought I'd mention a couple of credit positions. On the whole, we have been reducing credit. That is because credit spreads in this more risk-on environment, in our judgment, credit spreads have narrowed substantially, and a lot of riskier credit positions have become less interesting. So here are a couple. There were a few of our largest holdings, Aberdeen Perpetual and a BP Perpetual. And many of you will know the perpetual market, but these are essentially bonds which by convention are called over a certain period of time, but within the bond mechanism, they can be extended perpetually, hence the name. But in the circumstance that they are extended, there is a step up in the interest payments associated with them. What you can see with both of these bonds is that they sold off very heavily in the aftermath of the kind of Liz Truss gilt market sell-off. A lot of pension funds were offloading corporate credit portfolios. This offered some of these kind of more risky names came onto the market. And these are not risky credits, but some of the kind of riskier bonds within their credit stack or longer duration bonds sold off very significantly. This was a great entry point for the funds, and these bonds have performed very, very strongly, and we took the opportunity over the half to exit those, given they deliver us over the kind of couple of years we've owned them equity type returns. And that's all been part of the very strong performance of our credit portfolio over the period. As it happens, despite the fact we've sold a lot of credit in the half year, you will notice actually that our credit weighting has slightly increased. That is because there has been an interesting opportunities in another part of the market that has turned up, and that is in the corporate index linked market. Again, a very high quality part of the market in terms of credit counterparties, but also a slightly less well followed and less well understood part of the market, and that has given us an opportunity to rotate some of our credit positions into those index linked credit on what we deem to be attractive yields. Essentially, as UK index linked sold off, as did some of the index linked credit. So that's been a nice opportunity to maintain some credit exposure on decent spreads at a time when spreads elsewhere in the credit market have been narrowing. So that's really just to canter through some of the underlying names. It's very much the approach of Capital Gearing Trust to have large amounts of low risk assets, relatively controlled exposure to risky assets, But where we have exposure to those, we're trying to do something interesting to generate additional returns. And that has generally worked very well in the half. So on that, I will pass over to Emma to talk a bit about the outlook.
Great, thank you, Alistair. So one of the central features of Capital Gearing Trust's asset allocation, which goes right to the heart of its mandate, is its current underweight to risk assets. And the underweight to risk assets is as a consequence of elevated US equity market valuations. And although our risk assets are largely invested in UK equities and are indeed heavily underweight US equities, our rationale for this underweight is that if the US equity market suffers a correction, it's likely to take most of the other major equity markets with it. These elevated valuations are becoming more extreme. The cyclically adjusted PE multiple of the S&P 500 is now in the 99th percentile of its recorded history. It was only higher during the dot-com bubble. Of course, the frustration with making a comment like this is that US equities have now looked expensive for some time and their run has just continued. So why then should we care about valuation? Well, I think in short, the answer is because it's difficult to make money from something when you've paid too much for it. The right-hand chart gets at this point and summarizes the averaged 10-year annualized return for given starting valuations of cyclically adjusted PE for the S&P 500 index. The end result is clear. The higher the starting valuation, the lower the prospective return over the next 10 years. We are now in the very tail of the 10th decile. So from here, we expect the 10-year return from the US equity market to be near zero in real terms. Of course, these measures can't speak to the timing of an equity market correction. That's likely to require a catalyst or a change in investor sentiment, and there are many of those potential catalysts in view. Increased geopolitical tensions, potential for slowdown in the US economy after an extended government shutdown, fiscal concerns across virtually all of the major developed government bond markets, and increasing leverage, just to name a few. I'll speak in more depth about a couple of these over the coming slides. But before then, this next slide speaks to a similar point, but in relative terms. The left-hand chart looks at the relative value in real terms offered by US equities on a present Cape yield of around 2.5. This is as compared with two of the other main asset classes that we invest in, US and UK inflation-linked government bonds. 20-year TIPS are currently yielding around 2.4%, and 20-year index-linked gilts currently yielding around 2.3% rather on screen, risk-free. This relative value underscores the trust's underweight to risk assets and relative overweight at the moment to inflation-linked bonds across the US and the UK. Alternatively, for those who prefer things in nominal terms, and some people do, the right-hand chart makes a rough comparison, comparing the current earnings yield on the S&P 500 with the available yield to maturity on 10-year treasuries. The risk-free asset, in this case the 10-year treasury, delivers an excess return of around 0.5% on the S&P 500 earnings yield, or for a corporate bond, adding on the 10-year BBB credit spread, a 1.6% excess return. Now, while an equity earnings yield is not a direct yield read across from a nominal yield to maturity on a bond, it does make a similar point to the left-hand chart, which is just that on a risk-adjusted basis, it doesn't make sense to have a large allocation to equities at the moment. Now, turning to potential catalysts. One of the first is a slowdown in the US economy, which has just faced its longest shutdown. When we do have data on this, we'll be able to see the exact depth of the impact of the 43-day shutdown. Now, at the beginning of the shutdown, Oxford Economics gave the rule of thumb that each week of shutdown was worth around 0.1 to 0.2% off of quarterly annualized GDP. However, when assessing the costs and the length of this particular shutdown in depth, the US Congressional Budget Office estimated an impact of around 1.5 to 2% of quarterly annualized GDP. The right-hand chart on the slide uses Bloomberg's estimate for data source consistency, which is a little bit lower. But whichever of these you use, 1.3 to 2.0%, against a trend growth rate of approximately 1.8%, the extent of this impact on GDP growth has the potential to be significant. And given the extent of the positive sentiment around the US economy that has developed in US financial markets in the absence of official data releases, any negative surprises do have the potential to prompt a wider repricing, particularly in US Treasury markets, where both the fiscal and the growth outlook remain challenging. Looking closer to home, in fewer than 10 days, the government's annual budget event will be upon us. Increasingly, budgets have become a major event in the UK markets, and this one definitely has that potential. You'll recall that on account of a combination of poorer economic performance than expected, an inability to pass welfare spending cuts through Parliament, and very low levels of starting fiscal headroom, the UK now faces a fiscal black hole of around, depending on whose estimate you use, 20 to 40 billion pounds. Irrespective of whether you take the low or the high end of that estimate, this is now a challenging quantum to raise, particularly if one has made a manifesto pledge not to raise the rate of income tax, corporation tax, or VAT, which, as you can see on the left-hand chart, comprised 2/3 of last year's tax revenue. Of course, the Chancellor could break her manifesto pledges. Indeed, leaks last week suggested that she was looking to increase income tax rates. However, subsequent developments highlighted that it may actually be quite difficult to find a majority of Labour MPs to support increases to income tax or any material cuts to expenditure. In our view, the most likely response is a series of piecemeal increases to taxation, so things like freezing income tax thresholds, increasing tax rates on dividends, and then targeted taxes on perhaps areas like banks or gambling that allow the Chancellor to technically meet her fiscal rules, but not in a way that's definitive enough to convince bond markets of fiscal sustainability on a more sustained basis. At the margin, the impact of this approach is likely to place continued upward pressure on UK government bond yields and is also likely to dampen economic growth. This is, of course, on top of the widely publicised weak private sector demand in the UK, likely also a consequence of the extent of fiscal policy uncertainty that has been hanging over the UK for some time. Now, turning to the financial markets, the long end of the gilt curve has for some time been seen as a proxy for bond markets' confidence in the sustainability of the government's policies. And what we have seen in that respect is both rising long-end yields, but also rising term premia, as measured in the left-hand chart by the spread between the 30-year and the 10-year gilt. Of course, the UK is a relatively small issuer in a developed government bond market, which is increasingly plagued by issuers with fiscal concerns. The US, France, and Japan being some of the recent obvious candidates. But because we're also one of the smaller currency areas without the global reserve currency status that the US has, without the ECB backstop that, say, France has, that also makes the UK perhaps an easier candidate for a gilt crisis, as September 2022 showed. Add to that one of the headlines from the latest Bank of England Financial Stability Report, which is the existence of increasing leverage in core UK markets, for example, gilt and gilt repo markets, a problem which has also been the case in the equivalent US markets. The reason why this becomes problematic is that in markets which have the potential to be volatile, leveraged participants tend to amplify movements in the underlying markets, for example, creating additional selling pressure in a falling market. As a consequence, this leads us to be more cautious about the longer dated bonds which sit in our inflation-linked bonds portfolio, and we've continued to shorten capital gearing trusts' duration in this asset class, particularly going into a potential risk event. Yes, to summarize on this, we continue to be underweight risk assets as the US equity market becomes more overvalued against a market backdrop where there is an increasing number of catalysts for either short-term volatility or even a broader market correction. Given relative valuations, we continue to favour inflation-linked gilts as a portfolio hedge to equities, which appear increasingly expensive. And as a consequence of all these existing catalysts for volatility in core markets, we favour keeping overall duration constrained and continue to hold a material allocation to our managed liquidity reserve. Now, that was all I had to say, so I will hand the microphone back for Q&A.
That's great, Emma. Alistair, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. Katie, if I may now hand back to you to chair the Q&A session, and I'll pick up from you at the end. Thank you.
That's great. Thank you very much. And thank you to all those that have already submitted questions, but please feel free to keep them coming. So unsurprisingly, we have received a fair few questions on the HICL and TRIG merger. So Alistair, I'll direct these questions to you. I'll try and group them together. First and foremost, can you please describe exactly your views on the merger and also how you think CG publicising their opinions on this has been perceived in the market? And also, following on from that, please can you share your views on Bluefield Solar and Aquila and how these are different and why we're happy to have those holdings but be outspoken against HICL and TRIG merging?
Great. Yeah, thank you for those. For anyone that's not aware, I think it was yesterday, or actually the day before yesterday in the evening, I think there was an announced plan to merge HICL Infrastructure, which is one of our top 10 equity holdings, with a company that we don't hold, which is TRIG, the Renewable Investment Group. The Renewable Infrastructure Group. That was a holding that we sold out of over the summer. We feel that the proposed merger is an extremely poor deal for the HICL shareholders, which include Capital Gearing Trust. In a sense, the price that is being paid, in our view, for the TRIG assets is too high. That is because the deal has been done on effectively an FAV, that's fair asset value to fair asset value. Essentially, that means net asset value to net asset value with a few small adjustments basis, instead of the deal being done on a share price to share price basis. TRIG traded a wider discount, and that reflected the fact that there are concerns about the valuation of renewable infrastructure assets. It has a more leveraged balance sheet, and there are concerns about the UK changes to the UK subsidy regimes for rock assets. These are all kind of negative sentiments hanging around renewable energy at the moment, and part of the reason why we sold our holdings in the first place. There's also an opportunity for a number of TRIG shareholders to get out on preferential terms, and the manager's contract would be renewed and extended. So essentially you have a merger that delivers no material cost benefit, in which, in our view, value is passed from HICL shareholders to TRIG shareholders and the manager, and has resulted in an 89%, a completely foreseeable 89% drop in the HICL share price. So we are understandably very keen to stop that occurring, and if there are any other HICL shareholders on the call with a similar view, we would encourage you to get in touch. As relates to Bluefield and Aquila, we have small residual holdings of those companies. Both of those companies are in essentially wind down, or the portfolios are up for sale. So the assets are at a discount to the valuations, and the assets are seeking to be sold. And that kind of construct is a classic kind of capital gearing trust sale, where in principle you're buying assets at a discount and you'll get your cash back at higher levels. But part of the concern, I guess, increasing concern we've had around this sector is just seeing how hard it has been for Aquila to sell its assets at its stated NAV. That is why we are one of the reasons that we're quite kind of concerned about about acquiring the TRIG assets, essentially at a price that we think is too close to their NAV. So, I mean, I think with hindsight, we should have sold out of these positions completely in the summer. We sold out of a majority of our holdings, but we kept a couple that were essentially under strategic review or in managed wind down. We hope that even though they've been our small residual holdings in Bluefield and Aquila have been disappointing over the last few months, we hope that in their final stages they will recover some of those gains. I think there was a question about the kind of. Sorry, could you remind me, Katie? Was there one about the rating of the trust?
Yeah. No, absolutely. It's how you think CG is perceived following the letter. Okay,
so I think, as some of you may be aware, we released a public letter to the chair of HICL yesterday. Engaging in a highly public way is not our preferred way of engaging. We'd much prefer to have discussions with boards directly, and indeed other shareholders directly, rather than doing it in a public way. We felt with this proposed merger in particular, because the timelines are very short, there is a vote in mid-December to complete this acquisition, and we frankly don't want that to occur. We want to build the opposition that we had little choice other than to try and raise our concerns in a more forceful way, and to try and bring together shareholders who are minded to resist the merger going ahead. There's no reason why our putting out a public letter should be. Well, the first thing to say is we've had a lot of people contact us, and that is great. I think there are a number of investors who have appreciated the stance that we've taken. There is no reason that it should impact the rating of our shares in the market, either positively or negatively. The only thing that matters is the valuation of the underlying assets. Clearly, the fact that HICL has fallen by close to 10% has been damaging to the NAV, but we will control the discount in the market through buyback or a premium through issuance. So I don't think it has any material impact on the share price of Capital Gearing Trust itself.
Thank you. Before we move on to a different topic, we have actually received a couple more questions in regards to HICL and Trig. The first being, if we are a HICL shareholder, how do we best assist you in resisting the transaction or negotiating better terms? And the second question being, what would you need to see to like the deal or support the merger?
Okay, great. Well, the first thing I'd say is please get in touch either directly with us or with Katie, and we will pick the phone up and we'll start a dialogue. Ultimately, we would like to find an effective way to communicate to the board our resistance to the deal, collective resistance to the deal, and the strength of feeling out there. And we're trying to help shareholders to do that and magnify the voice of a kind of collective group. So please do just get in touch and with us through Katie or directly, and we will then in turn reach back out to you. What would we like to see? I mean, to be honest, we'd be perfectly happy if the transaction was simply called off. Another acceptable outcome to us would be if there was another bidder that came along a bidder for HICL that came along on better terms, or frankly, if someone would bid for Trig on better terms, that would take the problem off our hands. So, BBGI, for example, was taken private earlier this year at NAV. That's Bilfinger Berman Infrastructure. I'm not necessarily saying that's our objective, but if there were a better merger partner, one that generated cost savings as well as scale, that would be a good outcome. Or another good outcome would be if the terms of the deal were amended such that they were less adverse for HICL shareholders. So either to try and renegotiate the deal such that it's done on a share price to share price basis, or there be some option for HICL shareholders who don't want to have this combined portfolio to be able to exit from their holdings on the kind of terms that have been offered to the Trig shareholders. Any of these things would make it better. I mean, almost any outcome other than the transaction going through as proposed would be better from our perspective.
That's great, thank you. And since you said that, reach out to me directly. I've already received 2 emails. So if anyone else has any other comments, please feel free to email me at ir@cgasset.com. Moving on to Emma now, I'll give Alistair a bit of a pause. So the question for you is, in the light of your inflation expectations, and given that the interest cost on UK debt for the government is now over 100 billion a year, and second only to the cost of the NHS, have you considered the risk of an adjustment to UK indexing terms by the government, since these are such a large percentage of UK debt?
Yeah, it's a good question. I guess as context to that, the stock of inflation-linked gilts as a proportion of the total gilts and issuance is now somewhere between about 25 to 30%. One thing that the Debt Management Office has been doing in that respect to try and get this interest cost down clearly is actually just reducing the share of the flow of issuance to index-linked gilts. Clearly, it is the case that the government can change the terms. This has already, to an extent, been done with the changing of the rate of inflation used for index-linked gilts from RPI, which is generally a higher level of inflation, to CPIH in 2030, although I guess the extent of the difficulty and the lead time that's taken, given the potential for adverse effect on bondholders, suggests that it's not while it's possible and indeed has been taken, it's not a straightforward answer. I suspect in the very near term, the most likely thing that we're going to see is, I guess, a greater deal of financial repression for the other kind of 75 to 70% of nominal bondholders, with inflation running at above the Bank of England's target of 2% for the near future.
That's great. Thank you very much. Now I think I'll move back on to Alistair. We have got a question on PRS REIT. So that question being, sorry, there's quite a lot here. So they are disappointed in the sale of PRS REIT at a discount to NAV, and in a sector where billions are flowing into the build-to-rent market. What are your thoughts on this sale of these sought-after assets?
So to frame the answer to that question, these assets were sold at a relatively small discount to NAV. I can't remember. The NAV has been ticking up because the assets have been performing well. I guess the context of this really, and I'm sorry I don't have all of the details to hand, I should, but the sale, the company was essentially sold for just under 120p, I think. Emma will correct me if I'm wrong. If we wind back the clock about a year and a half, this company was trading at 70p in the market. So it's a very good example of a number of these real asset companies trading at significant discounts, and the board really saying it's very hard for us to get anything done. We were part of a group that put Chris Mills and Robert Naylor, amongst others, onto the board. They'd done a very good job dismantling an investment company called Song or Hypnosis that had Song rights, another complex transaction. In this case, I think they did a good job testing market appetite and achieved a good enough exit. These assets are trading very well, but I actually think they are quite good. Those two directors who led this have quite good understanding of the underlying M&A market. I guess it was done against a backdrop. This sale was completed against a backdrop of kind of rising gilt yields that we've seen over this year, which was putting some pressure on a lot of kind of yield type assets. So I think in the round, it was an extremely good recovery of value from where this company was trading 1.5, 2 years ago. It's possible that there's been a little left on the table for the next person, but that is sometimes the way with M&A. And we were satisfied with the I think probably more than satisfied with the ultimate outcome. Emma, I don't know if you have anything to add to that.
No, I think that's right. I mean, I think we have been satisfied in the end with the outcome. I mean, the board has definitely run a very thorough sales process against a backdrop, an economic backdrop, particularly volatile interest rates, where it has been a challenging sales process. So yes, pleased with the outcome.
Great. I think I can move on to the next question now, Alistair, unless you want to add anything else.
Yeah, no, that's great.
Okay, great. So I'm going to consolidate another couple of questions. So with the government's recent consultation on changes to ROC and FIT subsidies, do you think this shift could influence other areas of public spending, such as PFI projects or social housing? Additionally, what are your views on how the proposed changes to FIT rates might affect the government's future access to capital markets and its ability to finance major projects? to you, Alistair.
Great. Okay, this is a real technical one. For those not deep in the renewable energy markets, FITs are feed-in tariffs, ROCs are renewable obligation certificates. These are both subsidy regimes for UK renewables. What happened a few weeks ago was that the government looked, historically, all of these subsidy regimes have been escalated at RPI, and indeed that is the basis of the on which they were designed. The government came out with a consultation on whether for the remaining years of the contracts they should be turned to CPI, which is a measure of inflation which tends to come out with a lower measure of inflation than RPI. And they put out two options, one which would just turn the RPI to CPI for the remainder of the contracts. The second, which would basically look backwards over, the best part of a decade and say RPI has systematically overstated inflation for that period of time. So we are going to freeze inflation escalators until that kind of overstatement has been caught up. I.e., suffice to say, it would be a significantly more punitive retrospective change to just kind of tinkering around with the inflation index to which these are attached. We were really surprised with the way this consultation has been put out. I mean, if there were just a consultation that said, should we stick with RPI or should we go to CPI? That has happened, for example, on UK government bonds. It wouldn't be a crazy thing. CPI, we're changing to RPI and CPI are basically becoming the same measure in about 2030. I think what that would raise the question is why would you bother? Because the savings you're getting from making this change on option one would be so small. You've just got about 4 years of CPI rather than RPI, and you've got a lot of grumpy investors because you've changed the basis of the contracts as they were written. Option two seems absolutely extraordinary to us. Essentially, it would knock between about 7 and 10% off the value of renewable energy projects. It would place some of the capital structures under real strain. Probably we'd see some dividend cuts. I'm just staggered that the government put this out as an option. There would certainly be legal challenge. It would certainly reflect a significant retrospective change. This wouldn't just be some tinkering with an index. This would be basically retrospectively changing a contract. So I don't know whether it would stand up in court. It would certainly be subject to extensive challenge, and any benefit from it would be more than wiped out by the fact that cost of capital would rise. So I think it's an extraordinary thing that they've done. I would be surprised, I am hoping that they put option two, this more draconian option, as a way of just everyone saying, oh, we'll take option one, that's fine, it only knocks a couple of percent off. But I think it's incredibly clumsy what they have done. There is no reason that in this need flow into PFIs and other government contracts, but of course it raises perfectly valid questions, particularly if this consultation and the outcome of this consultation would be settling on option two, then essentially you'd see basically a significant reneging on historic agreement. And you'd have to look pretty hard at a number of these adjacent areas, or at least reprice that risk. But I can see no automatic flow through, and we have heard nothing to say that this consultation would be extended to PFI contracts or other adjacent markets. So we're just going to have to see. It's quite a swift consultation. We'll know in about I think the consultation closes in about a month. So yeah, watch your space.
That's great, thank you very much. We are at time, but we are going to continue answering the questions. So if you need to drop off now, these will be published on IMC platform later on. So Emma, I'm going to move over to you now. What is the current duration of the portfolio's inflation-linked bonds TIPS exposure?
So overall inflation-linked bonds duration is about 6.5 years. Within that, the two component parts are TIPS, which currently has duration of 7.25 years, and that's down from about 8 years at the end of the quarter. Index-linked duration is currently 5.9 years, which is down from kind of 6.5 at the end of the quarter. As mentioned during the presentation, a lot of the motivation for this shortening has basically been a cautiousness around very long-dated maturities in the index-linked market. I guess the more general point to make is that our index-linked bond positioning is fairly squarely focused on the belly of both the UK index-linked and the TIPS curve, and that's a function of wanting to take advantage of the roll down that's now available in both curves because they are now upward sloping, but sort of avoiding too much the longer maturities and wanting to stay relatively towards the front end where, I guess interest rates or the yields available on the curve are still very much a function of direct expectations of interest rates.
That's great, thank you very much. And sticking with you, Emma, the next question is, are you still happy with your holding in JGBs, and what are your current views on the Japanese yen?
Yeah, good question. So our overall yen exposure is 6%. Within that, half of that is exposure to Japanese equities, half of that is to very short Japanese government bonds, which are designed to give a cash-like exposure. I mean, I guess as a medium to long-term point, every kind of world currency ranking, purchasing power parity type index shows that the Japanese yen is very undervalued relative to most of the main alternative currencies, and definitely relative to sterling. Clearly, the question around that is what is the immediate catalyst for yen appreciation? What it has been, particularly sort of last year, was yield curve and interest rate normalization in Japan. Clearly, some of the slight reversal on that has come from particularly the change in leadership of Japan, where the new leader of the LDP is called, I guess, tightening monetary policy stupid. Despite that, we are still probably in a kind of global currency and interest rates environment where most developed markets, particularly the US and the UK, are still going to see falling short-term interest rates. Japan, potentially still going to, over perhaps a slightly longer time frame, see rising interest rates. And so we do expect over a sort of more medium term to see continued currency appreciation.
Thank you very much. I'm now going to move on back to you, Alistair. So how can you describe our performance in comparison to some of our closest peers, such as Personal Assets and Ruffer?
Yeah, so Ruffer I'm less familiar with. It has a much more complicated portfolio, but if we were looking at the performance versus Personal Assets, the most significant difference is that Personal Asset has a much more substantial weighting in gold, which has been a extraordinarily strong performer over, well, really the last few years, but particularly over the last 12 months, which I think would explain quite a big part of the difference in performance between us and them.
Thank you very much. The next question is, please could you explain the rationale for the holding in North Atlantic Smallers that trades on a persistent discount and shows no sign of narrowing? Do you think that is more akin to a family trust such as Caledonia?
Yeah, it probably is more akin to a family trust such as Caledonia in that it has a principal who is the manager and significant shareholder. We have, to be honest, companies with that kind of structure have often traded very well. There's a lot of skin in the game. Other examples of that would be Investor, which we've periodically held, the Wallenberg's holding company. We do hold Caledonia. North Atlantic has been an exceptional long-term performer. It has been, as I think this question alludes to, it has been a weaker performer recently, in part because really the whole of UK small cap has been pretty moribund. And I guess looking back over the performance of the last 6 months, we've seen a number of the previously quiet areas kind of really firing into life, most notably emerging markets. Japan, I wouldn't say was previously quiet, but it is. It's been a feature of this half year that it's really been so dramatically outperforming the US. The one bit that really hasn't has been UK small cap. So we have a big exposure there through North Atlantic and some others. I guess coming back to it, we have a lot of faith in the manager. We get exposure to things like private equity as well as UK small caps without excessive fees. We have the trust itself has said that by the time the manager, Chris Mills, retires, it will buy in shares. So after he retires, it will manage the discount into 5% before it makes any further investments. So we will continue to back the manager. There's nothing in our portfolio that we will hold regardless of circumstances, but we think it will be a good long-term performer when UK small cap has its moment in the sun. We think this will do well. We think there's scope for the discount to come in. As and when that occurs, we would potentially look at selling down.
Thank you very much. In the interest of time, I'm going to ask one more question that can be directed to both Alistair and Emma. So you only have 1% allocated to gold, neither here or there to overall NAV. Why not sell and reinvest in indexing bonds at a good, realistic alternative, or make it a reasonable holding?
Emma, I think you should take that one.
Right. No, I mean, it's a good question, and it's one that we get asked all of the time. I think in general, the reason why we hold so many index-linked bonds relative to gold is, as the question suggests, we look at why do people hold gold, and largely it's been the case because it's been some kind of portfolio hedge for inflation, and indeed index-linked bonds do this in a more direct way. This situation where we think holding gold might really pay off relative to, say, holding an index-linked bond is clearly one of sort of all-out war and dispossession of property rights, which we think of as likely to be a very tail risk, and sort of hold gold, therefore, in proportion with our assessment of that. I mean, I guess the other points to make very briefly on gold is clearly it's very difficult to value, both because the demand function for gold, particularly as regards central bank reserves, is not terribly transparent, and the supply is it's difficult and slow to adjust. So it's very hard to come up with sort of what's fundamental value for gold. The one thing we would say is, given the price movements, that we've seen over the course of this year in gold, and given the fact that there is now as much gold on central banks' balance sheets as there was during the Bretton Woods system, when gold was in fact formally part of the monetary system. It looks fairly expensive, and it would be difficult to make for us a compelling case to add it from here.
Well, thank you very much, Alistair and Emma, and thank you all for attending today. That will just conclude the Q&A portion of this meeting, but if you do have anything else, please feel free to email me directly or add it into your feedback comments following this. Thank you, everyone.
That's great. Fantastic. Katie, Alistair, Emma, thank you once again for updating investors today. Could I please ask investors not to close this session, as you now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and I'm sure will be greatly valued by the company. On behalf of the management team of CG Asset Management, we would like to thank you for attending today's presentation and good afternoon to you all.